Welcome. I'm Brian Kelly, publisher of the MoneyLetter, and I'm here today with Greg Killilea. Greg's a financial consultant and insurance manager for Asset Strategy. Good morning, Greg.
Morning, Brian. How are you doing today?
I'm doing great, thank you. As most of you know, Asset Strategy is the sister company for MoneyLetter. And Greg's here today to talk about insurance and annuity products, which I'm happy to learn about. And one thing I wanted to ask you, Greg, I saw in your LinkedIn post this week that you call yourself the anti-insurance insurance manager. What's that all about?
Well, the main idea of this is in the industry right now, everybody's talking about the pros and the best part of all these insurance products and how this can help and how it can just be this great thing, and everybody's constantly repeating the exact same stuff. And I wanted to be a little bit different. And, I've done a lot of work in other jobs before, and I wanted to take a little satirical route to this and really make it stand out and be that different person. I don't get me wrong, I do love insurance, but let's take this a lighter, easier way and make it seem like it's not this like mystical product that everybody like is going to get. I want to say like maybe that people like are afraid to buy because they don't know what it is, and give them the information in a way that they can laugh about and go, oh, that's pretty cool. That's nice. Maybe I should look into this.
Well, good luck with that, Greg. And I think you've actually already achieved quite a bit because you are different. There's no question about that. So, but let's kind of get into it. And let me ask you about some of the things that, that are important to MoneyLetter subscribers and potential insurance customers. And one of the things that we talked about before we came in this morning, and I know that you're excited about, is the transfer of risk from the client to the insurance company. So tell us a little bit more about that.
Okay, the big thing about annuities, you're basically transferring the longevity risk of your retirement income from yourself to the company. Basically, you're going to give them a sum of money. You're going to have the company ensure that it's going to last for as long as you live. Now, some people will have it, will last the appropriate amount of time, and this gets to the dark point of insurance where they'll pass away right as the money expires. There'll be some people, unfortunately, that will pass before the money expires, and the best part about that, there's provisions in these annuity contracts that will then pay it out to their beneficiaries. Now, when you win against the insurance company, what that means is you live longer than your money was in the amount of money was in the contract for. So say you put in $300,000 into an annuity and it pays it out completely in 20 years. Well, you're still alive after that. Guess what's going to happen? The insurance company, if you pick the right option on the payout, you have to pick the right option. You can't pick just a straight 20-year term. You'd have to pick the full life option pay.
Right.
That means they'll continue to pay that money until you die. So if you live another 10 years, you're living on the insurance company's books instead of your books. So that's the big transfer of risk that a lot of people don't know about, and they always get nervous. Oh, I'm giving the insurance company money. What's going to happen? Well, if you outlive the amount of money you gave them, you won. And you're still going to get that contractually obligated payment that you set up for.
So this may be more attractive to people that are relatively healthy, it seems to me. Does that make sense?
Yes.
Yeah.
Yes, yeah. Definitely. And I mean, if you know you're relatively healthy, but you have not saved enough, starting a contract like this will help quite a bit, because you'll know that you can consider this your paycheck, and whatever you have left after that is your paycheck. So this will be that paycheck, that steady yearly or monthly, however you want to set it up, income that comes into you, and you know what you're going to get every month or every year. And so you can budget around that, and then whatever else you have at the end, you can figure out what you want to do with it.
Interesting. Now, we just talked about some of the benefits. Are there any downsides to this type of a contract?
Well, you lock your money up. A lot of these contracts have surrender charges. So it's in between somewhere, say 3 to 10. Some contracts even go 14 to 20-year surrender charges. You have to deal with that. And then the next part is, the other downside is, when you turn on that income stream for the annuity, once you turn it on, you can't turn it off. You basically start that last part of the annuity contract and it's a full force and you can't stop it and it just goes. And you can't change it either.
Well, so, but you know what that amount's going to be. So
Yes.
there's no confusion there or surprises.
Right.
Right. Okay. One of the other things that I know that you and I have talked about in the past, I know we did another video maybe 6 months ago, and you talked about the power of zero.
Yes.
And that's got to do with a floor on one of these contracts and reducing risk for the person. So can you tell us a little bit more about that?
So I'm gonna spit out some just acronyms right now. On the MIGAs and the FIAs, we'll get to this later. We're going to talk about that. There's too many terms that are always being floated around. But on the MIGAs and the FIAs, you have this thing where you know that even if the market goes down while you're on the growth phase. So there's two parts to annuity. There's the growth phase, the accumulation, and then there's the payout phase. I'm going to use the very simple terms because I'm going to try to get rid of all those insurance speak things.
Thank you.
Once during the growth phase, you're going to have some bad market years. And what's going to happen is it might go -10, -20, -30.
Like 2022, the market was down.
Oh, yeah.
Stock market, I
Yeah.
should say. Yeah.
So what would happen is if you had a 0% floor, well, that means you're just going to have a 0% growth that year. You're not going to take the negative, what was it in 20?
I think the market, I forget now, is off about 20%, I think.
Yes. So while everybody does -20 on their money, you're going to be getting 0. It should be a little less because there are some slight fees on annuities that the insurance company has to make their money on. So it might be like 0.5%, something like that. They're all different. It's going to be in the contract. You'll be able to go over this. I'll be able to go over this with the clients. But you're going to have a 0% floor while everybody else loses 20%. So the next year when it goes up, say 8-10%, you're going to have that 8% growth on that 0 that you did last year, while everybody else has to then play catch up because they're now -20, and then the next year is 8, and so now they're behind you, and
Right.
that whole feeling, you don't have to get nervous, you don't have to worry about, okay, is my money going to run out, what's going to happen, am I going to completely lose it? No, you have this nice floor that's going to protect your principal.
Now, that makes sense, and it sounds very attractive. If I, as an investor and a potential customer, there's got to be some giveaway for that protection.
The giveaway for that protection is there are caps on the upside of the growth.
Okay.
And if there isn't a cap, then there's a participation rate. So the caps sometimes go in between anywhere from 7 to 11%, depending on which company you use.
So that means that I would participate in 7 to 11% of the upside if the market was up, but if the market was up 30% that year, I wouldn't get the full 30%. I'd get that cap.
Yeah, you get that cap.
Right.
Now, then there's uncapped potential ones where sometimes they range anywhere between, I'm trying to remember, 25 to sometimes 65%, depending on what products the company uses. So let's give it a nice easy numbers. Let's say a 50% participation rate, because I don't have a calculator in front of me, and say the market goes up 30%. Well, guess what? You now got 15.
15.
Yeah.
So basically, you're taking the risk of the market and reducing it into a band that's more predictable.
Yes.
And reduces the chance of a negative return, a bad return for that year.
Yes.
That's seems to me that would be attractive to people that are moving on in years and maybe are not as are not as willing to take as much risk as somebody that might be a little bit younger.
Yes.
Yeah.
And the worst part about this whole thing is, I was just reading a report yesterday that said something like only 25-30% of Americans actually know about annuities and know what they are and how they work. And a lot more people would benefit from this type of knowledge, because then they could be like, oh, I can transfer that risk, I can play inside a band, and then I don't really have to worry about this bucket of money until I need to turn it on for later on income.
Tell me about the ability to not outlive what I've saved, as say I'm a customer. What do the products do so I don't outlive my money?
So I went over that before, and I'll go into like more a little bit better details. Most of the products, this is going to be in terms of the FIAs, which we'll go over next.
What's an FIA?
Fixed indexed annuity.
Okay.
So basically what that means is...
Sorry to interrupt, Greg, but you mentioned MIGA before,
Yeah.
and we do cover those in MoneyLetter.
Oh, yes.
So multi-year guaranteed annuity, correct?
Yes.
Okay.
The multi-year guaranteed annuities are more CD focused. They have a set percentage point that they're going to get for that set amount of years. And so you're just going to know what you're going to get at the end of that, say 3, 5, 7, sometimes 10-year range that you want to pick from. With the fixed indexed annuities, you have a bucket of indexes that the company lets you choose from. And so basically you have these buckets of money that you want to choose to invest in, and you can pick a couple of them to spread it out so that you're not like just set in one motion. And a lot of these FIAs also have a guaranteed portion to them. So I'm quite cautious myself. So I'll always put maybe 20-25% into the just guaranteed bucket, so that they can see what's happening and just know that even on a bad year, you might get a little bit extra than what you thought.
So when you're talking about the buckets, you're basically talking about diversifying your risk, right?
Always, yes.
Yeah. Okay.
Yes. And so then to get back to the how to not outlive your money, as I said before, what you're doing is you're giving the insurance company that money to continuously pay you out through their pooled funds. So all these annuities, all these contracts go into this giant pool of money that the insurance company has. And it's the same pool that the life insurance goes into. So with life insurance, the company is hoping that you outlive the insurance contract, because then they don't pay it out. With the annuity contracts, the insurance company is hoping you die before the insurance contract pays out. And therefore, that's why they like to play both ways, because one way or the other, they're still going to make their money, and they're going to still be able to help out everybody. Right. But with annuities, because there's that pooled money, no matter what happens when you turn on that spigot of money, that income paycheck, if you outlive that initial bucket of money that you put in, they're still contractually obligated to pay you out. And here's another kicker that a lot of people fail to like understand and have not been told quite a bit. If the insurance company goes under, a lot of people get nervous about that. They're like, oh, what happens if the insurance company goes under? Oh my God, what's this and all that? Well, in the other insurance companies in the state are required by law to pick up and honor those contracts.
Is that just Massachusetts, or is that every state?
Every state.
Really?
Yes. And the reason why in 2008, when AIG was about to go under, the whole thing, everybody got nervous and they had to basically save AIG. They're one of the biggest insurance companies in the world. They have quite a bit. If they were to go under, the amount of contracts that would have had been bought up by other companies would have put those companies out of business as well, and would have started this huge cascading effect. And that's why they had to prop them up and then save them. And it's weird to think of it like that, but that's how it would have been. And now that's the reason why the government came down and was like, okay, you guys have to have better cash reserves and take care of business better to make sure that this doesn't happen again.
That's interesting. It's not FDIC insurance like a bank account,
Right.
but it performs like that if all of the other companies protect each contract.
Actually, there's another little provision to this. Say there's a reason why I don't really like to put more than $250,000 of money into an annuity contract. If the person is if this is their only portion of their wealth, I don't like to do it because there is a feature that basically says that if the company does go under and they're having a hard time getting everything out and fixed up, you are guaranteed to get your $250,000 back per annuity contract.
Interesting.
Yes.
And that's like an almost insurance, like FDIC insurance for the banks.
Yes.
I'd like to hear more about that maybe on the next time when we have some more time.
Definitely.
So we talked about MIGAs a little bit and the fixed indexed annuities. What's a variable annuity? Can you talk about that?
A variable annuity is that's more of a broader terms for, when you want to put your money more into directly into the market, that then happens. Basically what happens is you have a huge selection of the market, like ETFs, right? It's ETFs, right?
ETFs.
Yeah, I always get the ETFs and EFTs all mixed up
No,
for some
it's
reason.
ETFs. Exchange traded funds.
Yes.
Yeah.
The ETFs, mutual funds, you have a whole choice to choose from inside these variable annuities. And you can actually directly participate in the market with full upside and full downside.
Okay.
Now, there are some new products which are buffered ETFs that are starting to percolate through the variable annuity world. Basically what it is you have a protected downside, say in between anywhere from 10 to 20%. So if the market, say you pick a 20% buffered ETF, if the market goes down 18%, you get 0. Now, if the market goes down 26%, you only lose 6%. So they're buffered ETFs to give you a little more protection like you'd normally have in the non-variables. And it gives people a little bit of peace of mind so that, hey, nothing, I can put my money here and I know even on a bad year, I'm not going to completely lose it all.
And again, there would be some giveaway on the upside.
Yes, you do have caps.
Right.
I think some of the recent caps I've seen have gone up to about 16, 17% on them.
Which, I mean, if you look at the history of the stock market, there have been years when the market's gone up more than that, but most years the market doesn't go up more than 17%.
Yeah.
So that's good to know.
Yep.
Greg, tell me about some of the unique features like extra money for long-term care. That's interesting to me.
So there are some riders, and when you ever hear the term rider on an insurance contract, it means it's that extra provision that will cost a little bit of money during the contractual years. It will come out of your base pay. It will come out of the base number. And what that does is some contracts allow for a 2 times multiplier, and some have a 3 times multiplier for when you go into long-term care, that you can get that extra bit of money to then pay for long-term care.
Wow. I mean, that's an issue that we get asked about a lot from MoneyLetter subscribers. So we have subscribers that are, entering the last several years of their life, and this is something that's important to them.
Yeah.
So this could offer some protection to them.
Definitely. Yeah.
Are there any retirement income focused points that you want to make for clients or potential customers?
There are a few other different riders out there that actually will give you growth on the income you receive while it's paying out. I just want to tease that a little bit because there's some companies that have it, some companies that don't, and it all depends on what you're willing to give up versus what you get. And there's a lot of risk rewards when you're doing annuity contracts because sometimes you're going to be locking up a lot of money. Sometimes you're going to be You're going to have a little less performance in the front end for better performance in the back end. And it all has to be what the client wants to do.
It's a lot of choices. It sounds like it could be very confusing. So I guess some time spent with you would be time well spent, because I mean, just sitting here and listening to you, that it seems like there's a myriad of options out there that you could choose that, and I guess tailor to your individual situation.
Yes,
Yeah,
yes,
yeah.
definitely. It's like a giant buffet. It's okay, I would like this, that, and other things, and then you stay away from a few of these other products and you're okay.
I can anticipate one of the questions from our subscribers, and that would be, is there a death benefit? If you're getting into an annuity, is there a death benefit as part of that?
Okay, so what, on a normal annuity without any riders, whatever money is left over that you have from the original contract, or while it's paying out from like your original bucket of money, that will get paid out to your heirs. On some annuity contracts, you can actually get a rider that will give a multiplier for the money that you have left over as a death benefit. So you can use that as sort of like a hybrid life insurance product.
That's presuming you don't outlive your money.
Yeah.
Right.
And some of these actually, you're not using this to turn on that spigot of money. You're actually just using this to multiply the death benefit, because that's what it's there for.
Well, it sounds like a sensible addition or rider to a contract, because if you happen to die before the money that you deposited into the contract, that would give you an opportunity to get some of that back for your family.
Yes.
Yeah,
Yes.
yeah. Okay. That's interesting. I think our subscribers would be interested in learning more about that when they call you.
Yeah.
And probably the last thing that we should talk about is, if we have a reader, subscriber that's got an old annuity contract that they don't like, or they're not too sure about, is there something that we can do or you can do with that?
Yes. There's two parts. There's one, I'm going to put this into two parts. There's one with a surrender charge, and there's one without a surrender charge. We'll start off with the easier one, the one without a surrender charge. If you're out of that surrender charge period, it's very, just give us a call and say, hey, mine's not doing well. I would like to check up on this. What can you do different? How can I make this better? Perfect, no big deal. If you're still in the surrender charge period, well, where are you in that period, and how many more years do you have left? There are products out there that come with a bonus to offset the surrender charge, so you don't lose your initial base of money that you have. But that's only if your old contract that has to be if your old contract is just looking tired, beat up, and just bleh. Mm-hmm. I don't want to, if it looks great, I'm not going to switch it, because let's make sure it works for you first and gets everything the right way. But I mean, if it's starting to look tired, a lot of the features are just not there, and the growth, and some of the old caps are 6-7%, even less, just because it was during our low interest rates years.
And now the caps are higher, I take it.
Yes.
Yeah. Okay.
So now all of a sudden it's okay, you have one of those 5-6-year-old annuities, and you still have 2 or 3 years left in the surrender charge. Well, we'll find a product with some good features for you, a bonus, and then make sure it has good caps for you as well. And if it works, great. If it doesn't, then we'll just keep you there, and we'll wait till you get out of the surrender charge period to fix it.
That's great. There's a lot of information here. Hopefully all you folks have found this to be helpful. MoneyLetter, on occasion, we'll cover some of this on our page 12 article. We do a financial planning article in each issue of MoneyLetter. We have done some insurance articles before, and Greg actually wrote an article for us a few months ago. So if you find this information helpful and you need to ask more, learn more about some of the things we talked about today, give us a call, and you can call us at MoneyLetter, and I'll connect you with Greg, or you could call Asset Strategy and ask for Greg, and it's Greg Killilea, and we'll set you up. We'll answer all the questions. We'll clarify all of this, It's a lot to handle, but there's some really good products here, I think, that can help people and MoneyLetter subscribers. So thank you for your time today, and have a great day.